Good evening, everyone. As have been said, my name is Ruben Machiriza, and I'm going to be taking you for Accounting for Managers 1. And just to give you an outline of how our lecture is going to be, we are going to introduce the subject topic for today. We are going to define terms pertaining the subject topic. We are going to attempt your assignment number 1, perhaps maybe 5 or so transactions. And then we'll have a question and answer segment. But if you happen to have questions as we go along, you are welcome to ask the questions, and then we can always attend to them as we go along. So the topic for today, I have decided for us to grab the bull by its horns, is the accounting equation. Why do I say grabbing the bull by its horns? Because this is the focus of accounting. This is the center of attraction. Everyone who studies accounting is looking forward to balance this equation. The equation says assets is equals to owner's equity plus liabilities. So for the equation to make sense to us, we have to first define the components of the equation, and then we'll look into how to make the equation balance all the time. So the point of the issue is this equation should always be in balance. As with any other equations, this equation should always be in balance. Only then can we then say our accounting system is sound. If this equation is not balanced, then we have a problem in our accounting system. Okay, so we are going to define these terms. What is assets? What is owner's equity? And what are liabilities? Step by step, so that you guys understand the components of the equation and hence why it should balance. So to begin with, we are going to define assets, and we are going to give you examples of these assets, and then the classes of these assets. So what are assets in as far as accounting is concerned? Assets refers to items that are owned by a business. So when a business is in operation, it uses certain type of items. Suppose we've got a delivery vehicle to assist our operations. Suppose we've got equipment to assist our production process. Suppose we've got, sometimes you find stationery to be assets, but that would be a story for another day. But what I'm saying today is an asset is anything that a business owns for the purposes of generating income. So that which we own for the purposes of generating income is what we refer to as assets. These assets can be categorized into two classes. We've got non-current assets and current assets. We've got non-current assets and current assets. Those are the two classes of assets that we have. What do we mean when we say current assets? We mean assets that are expected to be used within the accounting period. Assets that are expected to be used within the same accounting period or within the current accounting period. An accounting period is composed of 12 months. So if we expect to use something for 12 months or less than 12 months, we call them current assets. And if we expect to use something for more than 12 months, we call them non-current assets. So the current or non-current nature of an asset is determined by the time we are going to use that asset for. For instance, we have got inventory. Inventory is a current asset in the sense that we expect to use them in the current accounting period. And motor vehicles are non-current assets because we expect to use them for as long as the business remains in existence. So that's the difference between current and non-current assets. It all lies in the period for which we expect to use those assets for. So we want to move on to the examples of assets. As I understand, you guys are new to accounting and you might not be familiar with some of these terms on your screen. So we'll start with current assets. On the left hand side of your screen, you'll see that under current, we've got inventories. Inventories refers to the goods that we trade in. Suppose we are buying and selling cooking oil. Cooking oil becomes our inventory. So as long as we have cooking oil in our warehouse, we've got inventory and therefore we've got current assets. We also talk of debtors. Debtors are people who owes us money. So sometimes you find that a business sells goods on credit. So when you sell goods on credit, it means you have given someone your cooking oil and they haven't paid as yet. Those are called debtors because they owe us money. We expect to be paid by those people. And we will find that cash is also a current asset in the sense that when we hold cash in the business, we expect to use it in the current financial period, which I said is the period of 12 months. And you also find that the cash that we keep at bank or a bank balance is a current asset in the very same way that cash is an asset in the sense that we expect to use it in the current financial period. And then we move on to non-current assets. You'll find them on the right-hand side of your screen. On the non-current assets, we've got the land and buildings, the land that the business possesses and the buildings in which we operate in. I expected to stay with the business for as long as the business is in existence. So they stay with the business for a period of more than 1 year. This therefore means they fall under the non-current assets. We will also find vehicles under the non-current assets because we expect to keep the vehicles for a period of more than 1 year. And also we find equipment, as I have said earlier on, since we expect to keep equipment for a period of more than 1 year. So the thing you need to know about assets is that they are simply items that the business owns for the purposes of generating income. And under the assets, you'll find current assets and non-current assets. And assets are a component of the accounting equation, which is the topic of the day. Now, we want to move to the second item on the accounting equation, which are liabilities. Liabilities are amounts that we owe to other businesses. So when we are in operation, sometimes we might find that we face difficulties in financing our operations. We have to borrow money from financial institutions, from friends and family, or from any other source apart from this that I have just mentioned. When we borrow the amounts of money, we are expected to pay them back, and we term them liabilities in accounting. So any amount that we owe to other businesses are called liabilities. And these liabilities, like assets, also falls under two classes: the current liabilities and the non-current liabilities. The current liabilities are those liabilities that we are supposed to pay within the next 12 months or within the financial year, which is a period of 12 months. So if we borrow someone money and we're expected to pay them back within a period of 12 months, it falls under current liabilities. But when we borrow someone money and we're expected to pay them back in 5 years' time, they fall under non-current liabilities. So current in the sense that we have to pay them in the current accounting period, and non-current in the sense that we do not have to pay them in the current accounting period. So that's the demarcation between current and non-current. So whenever you find the two, current and non-current in accounting, it refers to the period in which that particular item is expected to be settled. In the terms of in the term of assets, we expect to use them in 1 year. In the term of liabilities, we expect to have paid them back in 1 year. So when we talk of current or non-current, we are talking to the period either of payment or of usage. So that is it about the liabilities, and would want to move on to the examples of liabilities. So under liabilities, as I said, you find current and non-current. And to the left-hand side of your screen, I have listed current liabilities, which are popular at your level. The current liabilities, the first one, you see there, I have written creditors. Creditors. So sometimes when we operate our business, we buy goods on credit. Suppose we do not have enough money to purchase the goods, and we talk to our suppliers that no, please borrow us some goods, give us so liters of cooking oil, and we'll pay after a particular period. Those people or that event create creditors. So creditors are simply people whom we owe money because they've given us goods on credit terms. And then under creditors, you will find a bank overdraft. From time and time, you'll find that businesses can use more money than they have in their bank account. The bank allows them to use more money than they have in their account, and that is called a bank overdraft. And that is a form of the bank borrowing us money. And when they borrow us money, they expect us to have paid within a period of 1 year. Sometimes it's within a month or two. It all depends with the type of the agreement that we have with the bank. But whenever a bank overdraft arises, we know that we have a current liability because we have to pay for that overdraft. And then the last on my list of current assets is the loan, and in particular, a short-term loan. A short-term loan is a loan that is less than, that should be paid in less than 12 months. So when we borrow money from the bank and we are expected to pay it back within a period of 12 months, it's a short-term loan and it goes under current liabilities. Now we want to move on to non-current liabilities. Non-current liabilities, you'll find that we have got long-term loans. So in some instances, we might borrow money from the bank and be expected to pay it within a period of more than 12 months. Perhaps it can be 5 years, it can be 10 years, depending on the amount of the loan. That becomes a non-current liability. As long as we are not paying back in the current financial year, it becomes a long-term loan. And then another example of a non-current liability are mortgages. Mortgages arises after we present title deeds to the bank, be it of our house or of our buildings or of our land, and we say, you know what, we are in a crisis, we need money. But here are the title deeds to our properties. If we fail to pay that money, you take our property. But at the moment we pay that amount, you give us back our title deeds. So that's how mortgages arises, and they are usually of periods of more than a year, because when you go for a mortgage, you would want a large amount of money, and that cannot be paid with within a single accounting period. So mortgages are always a long-term liability, and they fall under non-current liabilities. So those are the examples of liabilities. So we have so far described, defined, and explained two components of the accounting equations. Of the accounting equation, I mean, one was assets and the other we have just finished now, liabilities. We want to now move on to the last component of the accounting equation, which is the owner's equity or capital. But for the purpose of this lecture, let us stick to owner's equity. So owner's equity refers to whatever the owner of the business can claim from the business. Whatever the owner of the business can claim from the business. And there are four components of owner's equity, which are listed below the definition there. There are four components. The first one is capital. Capital is the money that the owner is invested in the business. So you want to start a business, you can't start business without money. You have a certain amount of money that you have, 500,000 rands perhaps, and you say, no, I want to dedicate this 500,000 rand to starting this business. That becomes capital from a business point of view. And the owner is to part ways with his money to invest it in the business. So at any given point or a time, the owner can claim this capital. Say he can say, no, I no longer want to invest in this business, and therefore I'm taking back my capital. That is why I have explained owner's equity is what the owner can claim from the business. And then under owner's equity, we will also find income or revenue. Income or revenue. This is the money received on a regular basis for goods sold or a service offered. So as we conduct our operations in the day-to-day running of business, we are dealing with a certain product or a certain service. As we offer that product to our customers, they are bound to pay money for that product or a service. And when they pay money for that product or a service, we generate what we call income or revenue. Sometimes you'll find they will write sales in the sense that we would have sold something to the customer, and in return, they would have paid for that product or a service. And then moving on, you'll find that under owner's equity, we also have expenses or costs. We also have expenses or costs. Expenses is the amount of money needed to pay for or to buy something. So when we conduct our business operations, every now and again, we will need to pay for certain things. We will need to buy certain things. For instance, we are renting out a building. We are operating from a building that does not belong to us, and we need to pay rentals. That is an expense or a business cost. Suppose again, we want to pay for insurance to insure our products. That is again an expense. So the moment we pay for something for the purposes of conducting business, it becomes an expense and it falls under the owner's equity or capital. So just to mention one thing about the income has got an effect of increasing the owner's equity, because we are saying we have sold good and we have received money. That money quickly goes as the owner's money. Suppose he has received money today and he decides to stop operations, that money goes with him. So income increases owner's equity. Now expenses have got an opposite effect on the owner's equity. Suppose we pay for rentals right now, it means we have reduced what the business owner can take away with him. Suppose he wishes to close business today, you would have to take the income, subtract expenses, then whatever remains is what goes with him. So expenses have got an impact of reducing the owner's equity. Now we want to move on to drawings. Drawings are the opposite of capital. We have said that the capital is the money invested in the business by the owner. So when the owner puts in money in the business, it's called capital. But when the owner takes money from the business, it's now called drawings. When the owner takes money from the business, it's now called drawings. And the drawings have got the same impact as the expenses, in the sense that they reduce what the owner can claim from the business. They reduce what the owner can claim from the business. So the owner can take money or goods. The owner can take money or goods. Drawings can come in the form of money or goods. Whichever instance, it has got an impact of reducing what the owner can claim from the business. So that is it about the owner's equity, which I have said is composed of 4 items: capital, income, expenses, and drawings. We will see very soon how each of these will affect the accounting equation. So these are the three components of the accounting equation. I have said the accounting equation states that assets is equal to owner's equity plus liabilities. And we have defined assets, we have defined liabilities, we have defined owner's equity. Now we want to define what is a transaction or what is a financial transaction. So in the accounting world, we deal with what we call transactions. We deal with what we call transactions. And what is a transaction? A transaction is an accounting event that is of monetary value. So if anything happens today and it has got a monetary value, it's a financial transaction. Suppose we've sold goods with 500 rand, that is a financial transaction. And there are things that you should know or that you should note about each and every transaction in as far as the accounting equation is meant to balance. The first thing to note is that each transaction has got two accounts. Each transaction has got two accounts. So if we are given a transaction, the first thing that we must look for in that transaction are the two accounts involved. And then of those two accounts, one account is meant to be debited, the other account is meant to be credited. In accounting, when we say to debit, it's like you are increasing the amount of that account. And when we say to credit, it's like we are decreasing the amount of that account. So the equation is meant to balance because one account is debited, the other account is credited. You will see as we attempt an example in the following slides. So by the virtue that one account is debited, we are adding on one account and we are subtracting on one account. Mathematics would tell us that would remain with zero, and then the account is bound, the equation is bound to stay balanced, but you'll see from a practical example. And then how do you know which account to credit and which account to debit? We have a golden rule in accounting that is here on the third point form. We credit the giver and we debit the receiver. Whoever is giving, whichever account is giving, we credit it. And whichever account is receiving, we debit it. So we credit the giver and we debit the receiver. Then last but not least, we always view transactions from a business perspective. Remember, we are accountants and our loyalty lies with the business. So when we view these transactions, we view them from a business perspective. So I would like us to look at an example of a transaction and then move on to identify the accounts of that, the accounts that we would find in that transaction, and we'll move to identify who are we crediting, who are we debiting. So let's go to the next slide. So in the slide, we've got an example of a transaction. It says here, the company bought stationery worth 100 rand in cash. Does it qualify as a transaction? We first look, is it a business event? Yes, because it consists the company. Is it of monetary value? Yes, because we spent 100 rand, so it qualifies as a transaction. So for every transaction, what is it that we look for? We look for the two accounts involved. So in this particular instance, we want to look at the two accounts involved. How do you know which are the two accounts involved here? The thing that you should know is in every transaction, one account is always giving and one account is always receiving. So we identify which account is giving, we identify which accounting is receiving. After that, we would then know the names of the account that we are dealing with. Excuse me, I just want to minimize my screen right now. I want to minimize my screen. There we go. On the example, because I want to be able to be showing you how we identify the accounts. So what is happening here? We are buying stationery using cash. What is stationery? Stationery are those things that we use in business. Suppose we've got bond paper, we've got pens, pencils, we've got printing machinery, and other stuff that we use just to record our day-to-day running of business. The invoice books, the cash books, those are the stationery that we talk about. So that in itself, we know that we've taken cash. It means that cash becomes an account. Cash becomes an account in itself because money is coming from cash. So for us to realize an account, we want to note where the money is coming from and where the money is going. The moment we know where the money is coming from and we know where the money is going, then we know our accounts coincidentally. In this aspect, money is coming from cash. So cash is the first account that we have. What are we using the cash to buy? We're using the cash to buy stationery. And that tells us that stationery also becomes an account. So we've identified the two accounts that are involved in this particular transaction, the cash account and the stationery account. Then we move on to the following step. One account is debited, the other account is credited. How do we know which account to debit and which account to credit? I have said the golden rule is we credit the giver and we debit the receiver. The giver of what? The giver of cash. Because from a business perspective, what we are giving away is cash. So we credit the giver. When we say we credit the giver, we know in that particular instance that to buy stationery, we are using cash. So the business is giving up cash to get stationery. So in other ways, cash is the giver that we are talking about, the cash account. So the cash account is meant to be what? To be credited. And the shortcut for credited in accounting is just a symbol, capital letter C and a small letter R. So when you see a CR, it means a credit. Then what is happening to stationery? Stationery account is receiving cash. Stationery account is receiving cash. So we credit the giver and debit the receiver. Stationery account in this instance is the receiver. So what do we do with it? We debit it. As we debit the what? The receiver. And in short form, when we want to write debit, it's a symbol, it's a capital letter D and a small letter R. So that's a debit, that is a credit. So in as far as the accounting equation, this is all the things that you need to know. And then before I move over to the practical example, which is one of your assignment questions, I would like to ask from the audience if you have got any questions that you might need me to address before we move over to the example. If anyone has got any questions before we move over to the example, this is the platform right now. No questions from the audience, I suppose. So I'm going to quickly, I'm going to quickly move over to the question. This is one of your assignment questions, and I'm not going to attempt all of these. I'm just going to do with you perhaps 5 to 6 transactions. I hope by then you would have grasped the concepts of the subject topic. The question reads, the following are transactions of magnificent traders for January 2022. Magnificent Traders uses the perpetual inventory system with a markup of 25% on cost price. We'll talk about the perpetual inventory system, and we'll talk about the markup when we come across an instance where we need to use them. So we do not read the transactions in any question. We only read the transactions when we are attempting to answer the question. So for now, we skip the transactions and move to the required section. So what are we required to do? We are required to show how the above transactions would affect the accounting equation. Use the example below as a guideline on how to present the answer to the question. Ignore VAT for all transactions. You do not need to check the correctness of the duality principle. So we are given one example to follow and a list of transactions. So I'm just going to copy these transactions and put them into an Excel sheet that we are going to be working from. Okay. My machine is a bit slow, but we'll get there. Okay, so this is the Excel screen. You see that this is the layout of how you were supposed to, how you were advised by the question to present your answers. That is the layout of how you were advised to present your answers. And we are going to put the questions just here so that it becomes closer to where we are putting the answer. Becomes closer to where we are putting the answer. Okay. Okay. I don't want our questions to look this way. This one is better, I suppose. So there is our question. I have read the question, so we are going to quickly go. Okay, perhaps let me explain the example before we go to the question. We were told by the example that the business paid the wages for the week of 1,000 rand. The business paid the wages for the week of 1,000 rand. So we quickly come to our answer format and write on the number here, number 1. So what we want to do is to realize which account is being debited, which account is being credited, and this is our accounting equation. These three: assets, equity, and liabilities. And the assets of the company should be equal to the equity plus the liabilities. So this should remain in balance throughout the course of our transactions. So we were told that we paid wages and salaries for 1,000. We paid wages, sorry, for 1,000. So we want to first identify the two accounts involved. So we paid wages for 1,000. We want to identify where the money is coming from and where the money is going. So when we pay wages in the business, we use the bank account. When we pay wages, we use the bank account. So automatically, the bank account becomes one of our accounts in the question. And then again, the money from the bank is going where? Is going to pay wages. So wages is receiving from cash. So wages becomes our second account. Wages becomes our second account. Then what we want to do from there is to realize which account are we debiting and which account are we crediting. Which account are we debiting and which account are we crediting? What is happening to the bank account? The bank account is paying cash. So the bank account is giving cash. When someone is giving, we said we credit the giver and we debit the receiver. So we are going to credit the debitor, the bank account. The moment we realize that we are crediting the bank account, it means the wages account we are going to debit because it's receiving from the what? From the bank account. So we go to our format of the answer here, account to be debited. we come and take the wages account, because we've realized that we are debiting the what? The wages account. And which account are we crediting? We have established that the bank is giving. Therefore, we are crediting the what? The bank account. And the following step after that is to realize each and every account. What is it? Is it an asset? Is it equity? Or is it liabilities? We go to bank. Now, for the purposes of this lecture, you guys are not yet familiar with these terms. What is an asset? What is an owner's equity? And what are liabilities? So I've given you this window here with the components of the accounting equation to make it simple for you. So we've got bank. We just come here. What does bank fall under here? It falls under the assets. It falls under the assets and current assets, to be specific. So the moment we realize that the bank falls under assets, we ask ourselves, what is the bank doing? Is the bank giving or receiving? If it's giving, it means we are parting ways with money, and we can only reflect so with a negative sign, because we are giving. And when we give in accounting terms, it's as good as we represent it with a negative sign. And then we move on to the other account. We want to identify what account is it. What account is it? Wages. So all the wages are expenses. All the wages are expenses. But remember, I said the expenses is when we pay for something for the smooth operation of business. And we have to pay our wages so that the business remains in operation. That becomes a what? An expense. So wages are expenses. Where do we find expenses? Under the owner's equity section. Under the owner's equity section, you'll find that we've got expenses here. And in bracket, I've given you a hint on what that particular expense is doing to the owner's equity. So as I explained earlier, that expenses have got an impact of reducing the owner's equity. Expenses have got an impact of reducing the owner's equity. If we pay wages, it means the money that is left behind for the owner is reduced. And therefore, that should be shown on the accounting equation. So we go to equity, since we have realized that it's equity. And what are we doing? We are subtracting 1,000 rand from the what? From the equity account, from the equity component in the equation. So how do we know that our equation is in balance? We've said that the assets should be equal to the equity and liabilities combined. So what I want to do right now is just to create a box, a cell here with the addition of what? Of assets, total assets, and total liabilities. So these figures here, this one, which is an addition, this one is an addition of equity and liabilities. We've added the equities column and the liabilities column, should always be equal to the assets of the what? Of the company. The moment these two are not in tally, then we know that somewhere, somehow, we have not followed the principles of accounting. So that is the example that they gave you on that on the question. We will now want to move to the question in itself. We want to move to transaction number one. Transaction number one, which I have highlighted here, or perhaps let me put color to it so that we all see what I am reading. Transaction number one says, the owner increased his capital contribution by 120,000 rand. We have talked when I was defining the terms that capital is money that is invested by the owner. So whenever the owner puts money in the business, we call it capital. This is the instance here. And the question continues, the money was deposited directly in the business's bank account. So I have said that the moment that we are given a transaction, we want to know which two accounts are involved, because for every transaction, there are two accounts involved. So for us to know which two accounts are involved, we want to see where the money is coming from and where the money is going to. So it's easier if we start to look at where the money is coming from. So the owner increased the transaction, read again. The owner increased his capital contribution by 120,000 rands. So the money is coming from where? From capital. So capital becomes one account that we have. Let's just delete this. We're done with this one. So capital becomes one account because the money is coming from where? From capital. It's a capital contribution, and hence the money is coming from capital, which is an account in itself. And where is the money going? We have been told by the question that the money was deposited directly in the business's bank account, which means the other account in this question is the bank account. Is the bank account. Now we want to realize who are we debiting and whom are we crediting. We first look at the capital account. What is the capital account doing? The capital account is giving to the bank account. And we have said that we credit the giver and debit the receiver. So the capital account, we are going to credit because it's giving money to the bank account. And the moment you credit the capital account, I've said we know then that the bank account is going to be what? To be debited. So there we have realized our two accounts. We've realized whom are we debiting and whom are we crediting. So we might as well put them in the what? In our answer sheet. So this is actually transaction number one. The other one was an example. Let me just put TG here. So this is transaction number one. So here it tells us the account, we want to put the account to be debited. Which account are we debiting? The bank account. So we come here and put what? Bank account. And which account are we crediting? The capital account. Here, account to credit is the what? The capital account. And then the final step is to realize on the accounting equation, where does the bank fall and where does the capital account fall? And I have said that we just go to our to this panel I have provided here. This is only for this is meant for today's lecture, but in typical exam situations or other situations where you have to provide answers, you will not be provided with this. You have to know from the tips of your fingers. So in this particular instance, we've got the bank account. What does the bank account fall on? It falls under assets and specifically current assets. So what is happening to the bank account? The bank account is receiving money. When we are receiving money, remember on the example, the bank account was giving money. So we put it with a negative sign. But in this particular instance is the exact opposite of that. We are receiving money in the bank and therefore it must be shown with a positive sign, but we don't spend our time on writing the positive sign because we know the moment we present a number without a sign at all, it means it's a positive number. So we are increasing the bank with how much? With 120,000 rands. We're increasing the bank with 120,000 rands. And because we have not entered the transaction for the other account, you see that our equation is not in balance here. On the assets column, we've got 119,000. But if we sum up equity and liabilities, we'll find that we only have negative 1,000 because we have only entered one side of the transaction. Therefore, we have to enter the other side of the transaction to ensure that our equation is in what? Is in balance. So we have dealt with the bank account. We might as well delete it because we no longer need it. Now we are left with the capital account. What is happening with the capital account? The owner is increasing capital, is increasing his capital. And therefore we go to the owner's equity section here. We want to see when capital is being increased, what effect has it got on the owner's equity? You see that here I provided you with capital, and in brackets I put a positive sign. So capital is increasing the owner's equity. Capital is increasing the owner's equity. When it increases the owner's equity, we go under the equity column and we put the amount of 120,000 to show that we are increasing the account. And then we move on to the next transaction. So you will see that the moment we complete the other entry, our equation comes to balance. Our equation instantly comes to balance. So the moment you see after completing the second entry and you see your equation is not in balance, you should quickly revisit your transaction and see where you have gone wrong and try to correct that. So that is it about transaction number 1. We move on to transaction number 2. Transaction number 2. Yes, transaction number 2. I'm going to highlight it again so that you will see when I read. In transaction number 2, we are being told that we sold goods on credit to CBA traders. I have explained earlier on that when we conduct our business operations, we are bound, depending on the nature of the business, we are bound at some point to sell our goods on credit because it's not always that the customers have got money to buy. Sometimes we are bound to sell them goods on credit in the hope that they will pay at a later date. So in this instance, we sold goods on credit to CBA traders. The selling price of the goods were 18,000 rands. The selling price of the goods were 18,000 rands. So the moment in accounting we see we sold goods, you will see as time moves on, the moment we see we sold goods, it means the account, we already have an account in our mind, which is the sales, or which I have explained in the slides earlier on as the revenue or the income. But the most common used word is the sales, because when we sell goods, we create a sales account. So we come to write our sales account on a rough working paper. And then, whom are we selling the goods to? We are selling the goods to CBA traders. But I have told you that when we sell goods on credit, we create what we call debtors, because they are meant to pay us at a later date, and therefore they are called debtors, or in modern accounting, they call them trade payables. Those people who are supposed to pay us a certain amount at a later date. But for the purposes of your module, we will stick to debtors. So whenever we sell goods on credit, debtors arise. Debtors arise. So the first account becomes the sales account. The second account automatically becomes the debtors account. Or if you forget that they are the debtors account, you write the name of the person to which the goods are going to. It's very, you earn your marks after writing that. Suppose in an exam situation, you don't know that if we sell goods on credit, we create debtors. You just write the name of that debtor. CBA traders becomes the other account. That is very allowed, and that will earn you marks. But we are going to use debtors for now. So when we sell goods on credit, we create what we call what? Debtors. So whom are we crediting? Whom are we debiting? Whom are we crediting? Whom are we debiting? We first look at the sales account. We first look at the sales account, and we've tried to locate our sales account in this or this section here. We see that we'll find sales account under the income in the owner's equity section. Under the income in the owner's equity section. And what does
Hello, guys. Are you done? Or maybe he got out by mistake? Hello? Hello? Oh, okay. All right, it's fine. Just give him a minute. I think maybe he got kicked out of the meeting by mistake. Just give him a minute.
Thank you. I was wondering what was happening.
Oh, okay.
But I'm back now.
Oh,
I just want you to confirm. Had I talked about sales and debtors when I got kicked out? Can someone tell me had I talked about sales and
Ruben? Hello? Ruben? What's happening? Okay, I think he's having some network issues, he said. Okay, let me try to text him on his phone.
okay. Hello, can you guys hear me?
Yeah, we can hear you.
Okay, I'm not sure if the problem is from my side or from the meeting link. Hello?
I think it's from your side. The network might be a bit unstable on your end.
Okay, very sorry about that. I'll try. Right now, I think it's coming through. When I went off, and I talked about sales and data, said you guys got the part on where I came up with the sales and data's accounts.
I think so. You can continue from there.
Okay. So I was saying, we want to realize which account is giving and which account is receiving. And in as far as accounting is concerned, if we give goods, it's as good as we have given money. And therefore, the treatment of goods sold is the very same treatment of what? Of money given to another person. So we want to identify who is giving money or who is giving the goods. In this particular instance, the sales account is giving the what? The goods. So we go ahead and credit the giver. The sales account is giving the goods. So we do what? We credit the giver. And what is the debtors account doing? The debtors account is receiving the goods. Or this guy here, CBA traders, is receiving the goods. So the person who is receiving is debited. So we have realized our two accounts, and we have established whom are we crediting and whom are we debiting. So we might as well move on to our what? To our answer sheet. Whom are we debiting? We just come and take who? The debtors account, since we have already established. So we write, we put in debtors. And whom are we crediting? We are crediting the sales, as we have already what? Established. Which accounts then are being affected? Are we affecting the assets account, the equity account, or the liabilities account? So we move on to the debtors. The first one to check. We come here for the purpose of this lecture. I have said we'll be using this platform or this pen here. So the debtors will find them under the current assets, because these are people who owes us money and they are supposed to pay. And it's as good as it. This is our cash, and where we find cash is where we find debtors. So how much? 18,000 rand. So we are increasing the debtors by 18,000 rands. Their assets, we go under the assets column and we put the amount of 18,000 rand. And then we move on to the sales account. What is happening with the sales account? We go and look at the sales account on our pane here, and we'll see that the sales falls under the owner's equity. The sales account falls under the owner's equity. And you will see that our equation is not in balance as of now because we've only completed one side of the transaction. The other side is the sales account. We'll find sales here on the owner's equity. And what effect does any income have on the owner's equity? It increases the owner's equity. So we are going to the equity account and increase it by the amount that have been stated by the transaction of 18,000. So the moment we complete the double entry is the very moment our equation comes to what? Comes to balance. And then we know that we are in the right track in as far as accounting is concerned. Then we move on to the third transaction. We move on to the third transaction, just highlighting it so that you can see. We are told that the business paid the monthly premium for the business loan of 15,000 rand, which was transferred to Absa Bank. So I have talked about loans, and I have said that sometimes the business borrows money from the bank in anticipation that they will pay it in premium. So a loan is not paid back as a full amount. Suppose we borrow 50,000 from Absa Bank. When we repay that loan, we are not going to pay 50,000 at once. We are not going to pay 50,000 at once. We are going to pay a particular small amounts over a period of time. So in this particular instance, and those amounts are called premiums, or we pay them either on a monthly basis, on a quarterly basis, on a yearly basis. It all depends on the agreement of the loan. But in this example, we are told that it's a monthly premium and we are supposed to pay on a monthly basis. So this is a portion that should go to the repayment of the what? Of the loan. And it's a premium of how much? Of 15,000. So you want to look at how are we going to deal with this what? With these transactions. Okay. The first thing to do, we know that the business paid the monthly premium for the business loan. So the first thing that we know is we have got a loan account. We are paying for the what? For the business loan, which therefore means we have got a what? A loan account. And what are we using to pay the business loan? We use the bank account because whenever we pay business expenses, we either use the cash account or the bank account. But for large sums such as 15,000, we are bound to use what? To use the bank account. So the other account becomes the bank account. So what is happening here? The bank account is giving cash to the loan account. The bank account is giving cash to the loan account. So we credit the giver. What are we going to do to the bank who is giving? We are going to credit it for the reason that it is what? It is giving. And then we know we are done with the bank. So obviously, we would know there and then that the loan account is going to be what? To be debited. So you will see, if we are going to continue together, that these three items have got particular balance debit balances and credit balance. And it depends really on the item that we are dealing with, whether it has got a debit or a credit balance. But for now, let's move on to the next step in dealing with our transaction. We know that we are supposed to debit the loan account. So we come here under the account to be debited. We write the what? The loan account. And then we are supposed to credit the bank account, because remember, the bank is paying cash as part of a repayment to the loan. So we credit the what? The bank account. So we come and write what? Bank here. So which accounts on the equation are being affected? The first one is the bank account. By how much? We were told that it's 15,000. So what is the bank doing? The bank is paying 15,000. The bank is parting ways with 15,000. And whenever we part ways with money, I have said from the example that we resemble by a negative sign. And since we are paying, we put a negative sign of how much? Of 15,000, because we are parting ways with our money. And therefore our equation is bound not to balance, because we have not yet put the other side of the transaction. And then the other account that is to be debited is the loan account. The loan account. So we go here and we try to locate the loan account, where the loan account is. So it is under liabilities here. And the question did not specify what type of a loan do we have, but the treatment really is the same, be it a current liability or a non-current liability. The loan repayment treatment remains the same. So we are told that we paid back 15,000 rand. If it was a situation whereby we had received a loan from the bank, we were going to add that amount to our liabilities, because it then means our liabilities have increased. And when they have increased, it therefore means we have added an amount from the bank. But in this particular instant, we are actually repaying the loan, which means that we have reduced what we owe in terms of liabilities. If I can just read that one. Thank you, Mr. James. We have reduced what we owe in terms of liabilities. So the moment we introduce the word reduce, a negative sign should come to our mind. Our liabilities are going to reduce by how much? By 15,000. So it becomes negative 15,000 under the liabilities. So you will see that there, and then our equation comes to balance. If we say 137,000 here plus a negative 15,000, we get 122,000. And then our total assets is given us 122,000. So after that, we know that we are home and dry, and we have completed the recording of our transactions. So because of time, I cannot continue, but this is how we are going. If we are going to be together, this is how we are going to be tackling the syllabus one step at a time. We are going to be doing workings. I'm going to be showing you guys how you do your workings through PowerPoint presentations and practical workings, just as I have resembled with this one. So this is your first assignment. I'm not sure when it is due, but so far we have done the 3 transactions to your first assignment, and I suppose you guys can then move on to complete it on your own. If you should require anything as of this moment, you would have to communicate through Mr. James, and then I'll make that available. And therefore, this marks the end of our presentation. And I hope I have been talking to you guys and you have been hearing what I've been saying. So I'm going to hand you over to Mr. James, who will ask you if you have got any questions, and then we try to address them as they come. Mr. James, over to you, sir. Mr. James. Okay, let me try to get hold of Mr. James. Do any of you guys have questions or anything? Okay, Mr. James is here. Over to you, Mr. James.
Hi, how are you guys? Let's see. Okay. Thank you all for coming in today. So that's from Professor Ruben. I'm sure you enjoyed yourself. You learned a lot. I think the example that you did is part of your assignment, if I'm not mistaken. So you can see that the lectures could be useful to you in terms of doing your assignment. I would recommend we are going to be posting the prices for the lectures. It's usually 750 per semester. Or if you want to just do the assignment, it's usually 350 to just go through the assignment with the professor. So I will post again the information in the group for those of you that want to join in next time as we continue doing the assignment. So it's 350 if you just want to do the assignment, which is what we'll be doing, or it's 750 if you want to go through the whole semester, going through all the various lectures that we'll be doing. So I'll also post the date for the next lecture when we are going to do the next lecture. But for now, I'll post the details of the price, I'll post the banking details, I'll post the details of how to conduct such and etc. if you are interested in continuing with the lectures with us. Thank you for coming in today. I hope you have a pleasant evening.
Thank you.
Okay.